Good morning, good afternoon, good evening, wherever you are in the world, and welcome to our latest FS Club webinar on the theme of Is Big Tech Taking Over Our Money? And I am Hugh Morris, Senior Research Partner with Tien, and it is my privilege to be the chair of today's event. And let me first start out by most importantly thanking our sponsors, because without our sponsors, we would not be able to put on the FS Club webinar series, which from the attendance figures we get, we know are valued by people around the world. So a big thank you to our sponsors. Having got out of your way as fast as possible, we will then have the keynote presentation from Igor Pejic, who is an erudite author and commentator on matters technical and financial. And he is going to deliver his remarks on an extremely interesting subject of the presence of big tech in money. And we will then have Q&A for the second half of the session. So please do feed in your questions, which I will be delighted to relate to Igor. Now, more importantly, as I said, let me get out of the way and hand over to our expert presenter, Igor. The floor is yours.
Thank you very much, Hugh. Thanks also to the FS Club for hosting me today. Before we begin, let me briefly just share my screen so that we can also see some slides. And you should be able to see them now. Right, so again, thank you very much for the introduction. It is a pleasure for me to be here today with you and to be speaking about a subject that I think does not always get the attention that it actually deserves. I wrote and published a book last year about big tech and finance by the very same name. And this is also the topic of today's talk. And in writing the book, I interviewed dozens and dozens of different kinds of people. I interviewed bankers, tech executives, I spoke to regulators, politicians, founders, investors, and I talked to them about the future of finance. And as you can imagine, they didn't agree on much. In fact, there was only one thing they really did agree upon, which was that the entry of big tech into financial services will be the most transformative trend in banking over the last couple of decades. Some have even said that it's the most transformative trend in banking ever, full stop. Now, without spending too much time on the introduction, I will jump to the first slide and then tell you the three-step game plan which big tech is using to enter, expand, and lock the market. And then I'll talk very briefly about some of the promises and perils of big tech getting into the money business before concluding with the very basic thoughts of why I believe regulators and competitors can and should do in order to stay relevant in tomorrow's business of money. Let me ask and answer the first question of my presentation, namely, why do we have to talk about big tech in finance today? After all, this is what my research also showed, we had this discussion going back to the last century. For example, here in 1997, we had this rumor that Microsoft was going to build their own web bank together with telecommunication companies. And this is why many were very excited, positively as well as negatively, and many were fearing this step. We know that Microsoft did not build a bank, but we also know that every couple of years, sometimes even months, those anxieties and those positive excitements would flare up. So why today? Why now in the year 2024 is this relevant? Well, basically because today we have a number of groundbreaking technologies maturing at roughly the same time. And they're not changing only the way that we're doing business. They're not just changing and making us more efficient, but they are really changing the market dynamics, the way we compete. They're changing the actor groups that can compete. And they're also changing the way banks and financial services companies are actually making money. They're changing it in a way that they're moving banking to the digital age, which means that we're also competing in the digital arena. And this is an arena that demands core competencies that big tech carries in its very DNA. Now, we could probably spend a whole hour just talking about those mechanics and dynamics of the digital age, but just let me throw you some keywords, which would be double-sided platforms, winner-take-all markets, zero-based pricing, data monetization. All of those mechanisms will become ever more relevant in the future of financial services, and big tech knows how to do those things. So they are at natural advantage. Now, when I say big tech, I mean in particular the big five American tech giants. So this is Microsoft, it is Amazon, it is Apple, it is Meta, which is Facebook's parent company, and Alphabet, which is Google's parent company, plus a number of Chinese tech giants. And those are companies that are unseen in history in terms of size and power that they have. Now, those big tech companies, they are also innovation powerhouses. And the good thing is that they are pushing banking into the digital age. And while many of those discussions about big tech and finance center on the risks, which is legitimate because there are significant risks involved, we also have to acknowledge that they're doing a lot of good things and they're pushing innovation upon banking in an industry that has by many been perceived as very stale and very static. If we're honest, if it wasn't for Google Pay and Apple Pay, we would still be tapping our contactless plastic cards at the terminals. If it wasn't for the data centers of Microsoft, of Google, and of Amazon, we wouldn't have the dynamic market of fintechs and neobanks that we have today. And it wasn't for the likes of Alipay and WeChat Pay in China, we would still have millions and millions of people, rural Chinese people, living outside of the financial system. So it also has to do with financial inclusions, with usability, with lowered costs. And nobody of us is paying any more for those services than we used to. On the contrary. The problem, however, is this, that while big tech is really pushing forward this tech, neither regulators nor commercial banks or financial incumbents, such as payment processors, are ready for this. And this is problematic because if you look at the success stories of Google Pay and Apple Pay that are using a technology that is already a decade or so old, now we're dealing with other tech like blockchain and AI that are dozens and dozens of times more powerful in terms of their disruptive potential. And we will see this effect only in the future. Now, how does big tech go at it? Basically, it's 3 steps, and each of those steps is enabled by technological advances. They're always in the first step entering finance and banking through the payment sector. Payment is the window into banking. It's the most common touch point. It's also that fits best to the customer intimacy and the customer dominance that big tech corporations have. This has been enabled by and large by contactless technology as well as mobile technology, whether that be NFC chips like in the Western Hemisphere or QR codes in East Asia, for example, or text messages in Africa. And once they have entered the market, they're trying to expand. They're expanding horizontally, meaning that they are not just sticking to payments, but they're also going into lending, they're going to asset management and so on. But they're also branching out vertically. So while in the past they used to be focused very much on the customer front end, where they had their core competence, they're now trying to grab more and more steps of the value chain and push existing banks and existing incumbents of the traditional financial system into the back end. This has been driven largely by the proliferation of APIs and open banking mandates, but also by the rise of distributed ledgers. So far, so good. There's nothing bad about this. The problematic thing is the third step. When they're in and when they have expanded, they're trying to lock the market so that no more competition can actually endanger their profit pools. So they leverage platform economics, they leverage their gatekeeper functionality, and this has been enabled by big data and AI. This has been enabled by blockchain and digital assets. And I'll show you an example of each of those steps in just a second. So let's first look at how they're entering the business. I don't want to spend too much time on this. You all know Apple Pay, Google Pay. They've basically captured the customer interface for mobile payments. But there is hardly any big tech company that does not have their own payment initiative. In China, they have been dominating for years and years before Google and Apple did so in the West. Amazon is also very interesting to highlight because they're not just focused on mobile payments like Apple or Google are, but they are very strong in e-commerce payments with Amazon Pay. They're pushing into the physical stores with Amazon Go, pioneering contactless walkout technology, and they're even addressing the cash segment, right, with Amazon Cash. So they're very diverse, a very diverse tech giant. Now let's look at the expansion. Here is where it gets a little bit more interesting because this is what's happening at the moment. And I think the best example for expansion is Apple Pay Later. Now, Apple Pay Later is basically a functionality of Apple Pay for customers to not pay immediately for the purchases, but to split it up to 4 installments. It's like a mini credit, a mini loan. And why is that so significant? It's significant because on the one hand, this is a perfect example of horizontal expansion, right? So Apple is not just anymore focused on payments, but also on lending. And on the other hand, it's also it was a good illustration of a vertical expansion, meaning that Apple is trying to capture multiple steps of the value chain. It's not just the customer interface anymore, but they, even though they're still working together with Goldman Sachs, by the way, they are now ending the partnership, but they are cooperating with the bank on Apple Pay Later, and they are still doing risk management and credit assessment by themselves. So this is not in the hands of Goldman, which is a major core competence of banks. So I believe that this is a game changer. And how is that possible? Apple says that they have bought Credit Kudos, which is a British startup, an AI startup that basically crunches not just the credit bureau data that banks would have, but it also adds 10,000 variables, including many variables from the Apple ecosystem. So Apple knows exactly whether you have a MacBook, they know which iPhone you have, they know whether you're using iTunes, what music you're listening to, and so on. However, and this is a big, caveat here, this was very recently discontinued, right? So while this was an initiative announced last year, now this June they said that they would not anymore provide Apple Pay Later by themselves. Apple said they would continue with a third-party vendor, but not by themselves, which is very significant. They, of course, did not disclose why they don't want to do it, but I'm very happy to discuss in the Q&A section my hypothesis if you're interested in it. And Apple Pay Later is just one of the forays of Apple into the banking world. We all know, for example, the Apple Credit Card, again, in collaboration with Goldman Sachs. We have the Apple Savings Account launched in the United States last April. Last November, the UK became the first market worldwide to have Apple Connected cards, which means that I can go to Apple Pay, link all of my credit cards, link all of my bank accounts, everything to my app. So there's no need anymore to log into my HSBC account, to my Barclays account, and so on. So Apple becomes the one-stop shop for my financial life and takes all those touch points from traditional actors. It also worked, by the way, on an investment feature, as reported by Bloomberg. It was abandoned, perhaps because Goldman was already looking at ending the partnership, which seems to not have been as profitable as Goldman had thought. But Apple is also a perfect example of how they lock the market. We all know Apple, we all know their golden handcuff approach, right? So if you buy into their services, you have to get the whole ecosystem. And as long as you're in the ecosystem, everything works perfectly and seamlessly, but it's very difficult to combine it with other operating systems and other devices that are not made by Apple. But Apple also locks its payment business. And this is something that you might have read very recently because it was in the newspapers as well. Apple is blocking for years their NFC chip. Now, what does that mean? Basically, if I have an Android phone, a Google phone, so a phone with Android, which is Google's operating system, and I'm PayPal, I'm a bank, I'm a fintech, I can build my app that can basically be used for paying at the contactless terminal because it can simply communicate with the NFC chip of the phone. Now, with an iPhone, this wouldn't work because Apple specifically forbids all other apps except Apple Pay to contact that NFC chip within the phone. Needless to say that this is a very big misuse of market power as perceived by market actors. That's why, for example, in the US, you have many banks suing Apple for charging fees, illegitimate fees in excess of $1 billion. You had Germany a couple of years ago coming out with Lex Apple Pay, which is a law specifically designed to prevent this misuse of gatekeeper functionality. And you have now, and this is why I mentioned in the introduction that it was in the papers recently, because just a couple of days ago, Apple agreed with the European Union to open up their NFC chip in Europe for other actors. Because the European Commission had threatened billions and billions of euros in fines if Apple continued to prevent others from accessing this chip. Now, this is mobile technology, and you already see that the tech giants can have a powerful gatekeeper functionality. But if we look at more recent technology like blockchain, the ambitions and the possibilities opened up are tremendously higher. And no episode in financial history or recent financial history captures this better than Facebook's failed Libra initiative. Now, Libra, as you might know, was Facebook's attempt to issue a global supercurrency. It was not just Facebook, it was a group of 20 plus like-minded companies, heavyweights really like Visa, MasterCard, PayPal, Uber. So tech heavyweights, no banks by the way, but very successful companies. But they were headed by Facebook, and they wanted to issue their own coin based on a centralized blockchain and pegged to a basket of fiat currencies. Needless to say that the regulators in all countries across the world were not really happy about it, so they killed the project almost instantaneously. Facebook tried to water it down, called it DM, said there would be a US dollar DM, a UK based pound DM, a euro based DM, and so on, but it never caught off and the project failed. Now, there's a lot of things that I could say about Libra because it's an extremely intriguing project and it shows the ambition of big tech, but also the technological possibilities granted to big tech by technologies such as blockchain. But the most important thing that I want to highlight for our discussion is that if Libra had been successful, Facebook and its allies would have de facto had a monopoly on not just one, not just two, but three layers of the money business, right? So if it had been successful, Libra and the alliance, the Libra alliance, would have been the only one allowed to issue new assets, to issue new coins, new Libra coins or DM coins or whatever you want to call them. They would have been the only one responsible for settlement because the blockchain, the centralized blockchain, would have been under the control of Facebook and Libra. And also the gateway layer, which means how do you hold those issued coins, how do you transact with them, would have also been in Facebook's hands. Because the idea was to have Calibra, which is a subsidiary of Facebook, building a wallet that can hold those coins. Now think about it. This is not just competing at the edges of the money business trying to make a profit. This is really taking the control of commercial banks out of it, and also of central banks, right? This is why no central bank, no regulator, no politician was happy about that initiative. And another thing why big tech is so dangerous is because they are so quick in launching initiatives and especially scaling them. Now in 2019, I first learned about Yue Bao, and I was not the only one. Basically, this article of the Wall Street Journal shocked the financial world because it said, okay, all of a sudden we have the world's largest giant mutual fund, and nobody has ever heard about it. And it was called Yue Bao, part of the Alibaba empire. So it was actually not a mutual fund per se, but it was a micro savings tool from Alipay. So Chinese people that had their money uploaded, they simply had it invested by Alibaba and got some return. But the interesting thing is this article was from 2019, and Yue Bao was founded only in 2013. So within 6 years, they grew to close to 600 million users. In the year prior to this article, there were more than 100 million users of those 600 new coming into it as new customers. And this is why it posed a tremendous threat to financial stability, and why the Chinese government then also capped very quickly the number of new funds and the number of the volumes of new funds and the number of customers that Yue Bao was allowed to generate. But in the Western world, we have a similar example of this extreme speed. It's the Apple savings account that I mentioned just earlier. This was last April announced or started in the United States. And 4 days after Apple launched the savings account, it had more than $1 billion of assets under management, of invested money, and it had more than 250,000 people signing up for the service within 4 days. So it shows you that even if you have nothing on the radar, right? If you have no speculation, no rumors, because this was something that really was a surprise. You can have something soar from zero to systemically relevant within less than a week. And to come a little bit to some kind of conclusion, so new tech is, of course, a great thing, but it magnifies a lot of problems, in particular of platform problems. As I said, we had mobile technology 10 years ago, but now it's really groundbreaking, disruptive technology like AI and blockchain. and they will determine what finance will look like tomorrow. We'll have a multi-asset world, right? So it's not just going to be fiat currency. It can be privately issued coins like Facebook attempted to do. We will have cryptocurrencies, NFTs, whatever you name it, CBDCs, so central bank digital currencies. There will be multiple assets flowing around. And those assets will increasingly be interconnected. They will melt into each other. Off-chain assets as well as on-chain assets will be used in the same transactions. And of course, you have the issue of big data and the scale advantages it comes with, and of course with AI, because those that have the biggest data are also those that can build the most powerful AI algorithms. Now, as I said, this is a good thing, but it also fosters monopolies, right? It leads to systemic risk, as we've seen with Libra. Had it been successful, Facebook, the Facebook empire back then had about 3 billion customers. Today, Meta, so including WhatsApp and Instagram, they have about 4 billion. If you again add those heavyweights as MasterCard and Uber and so on, you will have probably reached every person on the planet, or almost every person. And the last risk is, of course, it's margin pressure for banks. And this is not something that should only concern bank CEOs or the boards or investors, but also the whole economy, right? So if you have underfunded banks or banks that are working with very thin margins, some kind of external or internal shock might end up costing the taxpayers a lot of money, right? Because those are systemically relevant institutions. So what must be done is basically that the regulators have to level the playing field in order to safeguard an efficient market. Now, this sounds good, but what does this mean in particular? Well, there's four things that I would suggest to do. One is to prevent big tech from abusing its market power, its gatekeeper function. I think that's what we're seeing happening, right, with Apple's NFC chip, but also in the UK, where Google has been challenged because they forced certain companies that are providing apps in the App Store to use Google's billing systems. So this is happening, I believe, in many markets. The second thing is that big tech has to be designated, I believe, as a systemically important institution. They have to also have some kind of license to operate, because today they're only having to fear penalties in case of non-compliance. But what should be done is to really give them a license to operate, because if they collapse or if anything of importance happens to them, they could take the whole system with them. Just to give you an example, in terms of cloud computing, so 70%, according to the Bank of England, 70% of all banks and 80% of all insurance companies have their outsourced cloud activities with only two tech giants, right? So this is a significant risk pool there, and this is why those companies should have some kind of better oversight and where they have compliance, where it's not just a business case calculation. Okay, how much money can I make versus how much do I have to pay in damages and fines. The third thing is, and I think this has already happened as well, that every time big tech is launching it or preparing to launch a stablecoin, especially if it's linked to fiat currencies or traditional financial assets, this should be forbidden or regulated, and that's what we've seen happening in the UK, but also in Europe with the MiCA, the Markets in Crypto Assets Initiative, because this can get out of hand very, very quickly, and it can affect the exchange rate of fiat currencies. And the fourth thing is, I believe that all entities, licensed or not, should be allowed to engage in the very same activities. Because I hear many voices, especially from across the Atlantic, from some of the more populist politicians, saying that banks should not be tinkering with cryptocurrencies, with digital assets as such. But at the end of the day, as I just said, I believe that we will have traditional financial off-chain assets with new on-chain assets melting together. We're seeing this happening with major European banks already. And if this really happens, then you cannot forbid banks and other licensed actors from entering this space. Plus, if you do so, right, you will have an unregulated space where big regulated institutions are not allowed to enter. So this will also not really help to increase the transparency and the systemic security. Now, that's what regulators have to do. The question is, what can banks do? What can market actors do, traditional financial institutions, in order to compete with them, right? Because it's not a good strategy simply to lobby against big tech, because as I said, there are good reasons why they're in there, and they have pushed a lot of innovation in there, and I think it's good. And I think that legislation like the Keep Big Tech Out of Finance Act, again, an idea coming from the United States, is not good, and that's probably also why it has not failed, because they are bringing a lot of good things into the table. But the question is, what can banks do? And to sum it up very, very briefly, I believe that they have to build something that I've called the super money engine, which means that, in very simple terms, that you have to be able to process all types of assets, whether that be traditional financial assets like stocks, crypto, like fiat currency, and so on, but also on-chain assets such as fiat currencies, cryptocurrencies, CBDCs, which is central bank digital currencies, also private stablecoins, right? But they should also be able to issue their own coins, right? Like JP Morgan is doing in the United States, so-called deposit tokens, but also NFTs, non-fungible tokens. And I'm not just talking about some kind of pixelated pictures, but also things such as intellectual property rights, commercial rights that are represented as a token on the chain. And when I say processing those, I mean holding, buying, selling, staking, swapping, putting them into DeFi protocols, putting them into smart contracts. So basically, I want to have a one-stop shop for all kinds of assets that will be used in the future. And this is not just something that I've come up in the process of reflection. That's something that you see when you take a deeper look at where some companies are going. If you look at their patent applications and their trademark applications, and in fact, it's big tech that's pushing to build this super money engine, in particular MetaPay. So of course, Facebook's attempt linked also to their metaverse initiatives a couple of years ago. And what we've seen is that Meta has filed 5 trademark applications indicating that they're building such a super money engine, including things such as multi-asset capabilities, cryptocurrency exchange functions, investment features, lending. So this is already happening, and if traditional financial actors don't want to be left behind, they have to get into it. Now, I know for banks it's a bit difficult because in many jurisdictions they still don't have the regulatory clarity, but I see some other traditional financial actors like MasterCard exactly going into that direction, embracing the whole diversified system of assets and being able to deal with them, or working at least to making it possible to deal with them. Now, as I said, this was just a very top line summary of it. If you're interested in how to build this super money engine, and if you're interested in whether smaller regional banks still have a chance, or whether that's only something that the Barclays of this world can do, I suggest you grab a copy of my book. That's where I go into more detail on those things. It's basically available in all major bookstores. If you want to read continuous analyses, I encourage you to sign up for my newsletter, The New Frontier. It's a monthly analysis of all of those things that are regularly happening and that basically play a big role in the future of financial services. And if you do so, you'll also get a free blockchain course and an asset cheat sheet. So thank you very much. This is it from my side. I hope I didn't go too much over my time. If you have any questions, feel free to reach out, or even better, feel free to ask them now so that we can all have a hopefully inspiring discussion. Thank you very much.
Igor, thank you. Outstanding discourse on a really critical subject, and I think it will become even more critical. And we have a lot of audience interest, which I'm not at all surprised about. So if I may, I'll feed some of the questions through, and starting with Nikki Holtzhausen, who asks, please could you comment on CBDC developments, especially at the BIS and Bank of England in particular? Which payment systems apart from blockchain are being considered?
Yeah. So the question is always, so maybe let's start with the global perspective. So I think CBDCs, we are still facing a lot of issues in the Western Hemisphere. I'm not talking about China and countries where political realities are different, where the approach to data security is different. I think that the Bank of England and the European Central Bank are probably perhaps most comparable. So they're very openly looking at this topic. They have been researching it for quite some years. and I believe that they intend to issue something. I just don't think that it will be before the year 2030. And the question will be then also how commercially viable will it be. So you need to have the end users buying. As to your question regarding what kind of technology it is, it's always interesting to see how different people are working with different terminology. I would argue that blockchain also includes centralized blockchains, and of course every CBDC is centralized, right? So I have never heard about a decentralized CBDC per definition, because the central bank is the issuer of the currency, obviously. That's why you have the digital pound and so on. Of course, you might say, okay, we have a blockchain, or some people would say this is not a blockchain because it's only decentralized. Others might say we need transactions to happen really in blocks, because then you have also some other blockchains that are just writing transactions off in a line. So I think that's a matter of semantics at the end of the day, but I believe that it is going towards to be a blockchain by a broad definition. And maybe one last comment in terms of the general state of CBDCs. You probably heard it that the U.S. Congress, I think it's also just a couple of weeks ago, that they passed a bill specifically banning the Federal Reserve, from issuing any kind of CBDC. So I think that this was, I don't know if it was the death blow for CBDCs worldwide, but it's definitely a very negative impact, and I think it will be felt in the UK and Europe as well.
Thank you very much, Igor. Clive Bullen asks, obviously relating to the deferred payment option from Apple, is there a danger that Apple, etc., encourage us to overspend and then we have to pay back at higher interest rates?
For sure there is, yeah. I think I would even say that this is so the whole buy now pay later business or sector is very much under criticism, because they are encouraging people to spend more, and especially because they're encouraging younger people to spend more, right? So it's usually, I would say, the TikTok generation and a bit older, right? So maybe up to 30. Those are the most heavy users of buy now pay later options, and it's people that, it's not like going to a store and taking a loan for a car, for a kitchen, or getting a loan for a car. This is usually very small ticket items, right? So you would buy something for a pullover for £50, and then you would split it into 4 installments. And of course, that has been a major criticism. And then, of course, what you try to do is you can say, okay, if you can't pay back now, then maybe you need a credit card or need a loan and so on. So this is definitely something that where you're absolutely right. So this is one of the big dangers of buy now pay later, and if you read the news, this is the major point of criticism they have.
Thank you very much. Charles Vermont poses a really core question when he says, surely what banking needs is greater competition.
Absolutely. I don't think it's a question as much as a statement, which I agree 100%. And that's why I said that, if it wasn't for Google Pay and Apple Pay, there would be no mobile payments. I'm pretty sure. I know that because I've worked in Austria with my old company back then. We had the first nationwide mobile payment initiative. The only problem is nobody took notice because people were not using it, right? Because it's not Apple, it's not Google, it's not easy. You don't have the access to the phones. That's why I say they're innovation powerhouses. I think they are very, very good. And the banks, in response to that, they have been pushed to innovate. So I think that generally it's a very welcome trend. We just need to be, people often read the title of my book and they think that I'm for banning big tech out of finance, and definitely not. I think it's a good development, but it's also one that is extremely risky because the risks are getting exponential. And that's why we need to be aware of it, and especially because we have this gap generally in innovation, right? So on the one hand, we have a rapidly evolving technology that's also accelerating, but on the other hand, you have regulators or regulation in general that is a couple of years behind by its very nature. So this is not something that this is not a criticism by any ways, but you have to brief all those lawmakers. They have to understand the technology that they had never anything to do about it, then you have to go through various committees and stuff like that. And while you're doing that, what you have been discussing 2-3 years ago is already sometimes irrelevant.
Thank you very much. Dan Feeney asks, I think it's quite an interesting question. So he says, what more should we be pushing big tech to do for society as we move into a fully automated and AI-driven business models in terms of both digital acumen and financial literacy among people? Well, it does seem, he adds, that the banks aren't great at these either, leaving many people behind or indebted.
Yeah, so I'll try to answer first to the financial literacy question. I agree. I think it's a very difficult topic, right? Because as soon as you're a bank and you try to educate your customers, right? On the one hand, you have shareholders saying, "What are you doing?" Right? You're spending the money and educating them so that they won't take loans from us. So it's contrary to our business model. And at the same time, even if you have good intentions, right? People receiving that information will always be skeptical. So I think that financial literacy is good, and banks and so on are doing it. In particular, I would say for better off customers, and that's one of the issues, right? Because if you have enough money, they can't make much profits by giving you loans because they are usually at a low interest rate. So what they do is they show you how to trade, how to invest, and stuff like that. So the profit generation mechanism is another one. So I believe that a lot of so many problems start that you don't get this in school, right? So of course, I believe that family is the first place where you should learn about finances, and we have many cultures where speaking about finances is always something that's you don't speak about money. The saying, and that's I believe wrong, right? And the thing is, of course, it starts in the family, but you have many people that don't have those financial literacy skills as well. Just look at statistics telling us how many people understand the concept of compound interest, which is a very basic one. So, and then you also look at other statistics that tell you that the overwhelming majority of people don't even get 2 or 3 offers when they're taking mortgage loan, which is by itself is probably the largest purchase they'll ever do in their lifetime. So I believe that schools are failing in financial literacy in many things. And this is a core skill that you need to learn, and you need to learn early, because those people that leave school early are those that are at most vulnerabilities. That's the financial literacy part. The other part is AI. So that's a very, very tricky question, of course, and it's one, at the end of the day, it's one how much of the profits you really give away. They would argue, of course, they are putting those LLMs, those large language models, out there, and everybody can use them for free or for 20 euros or dollars or pounds a month, which is not very expensive, right? So if you're using it heavy, and they would say they're claiming anyway they're good. The other problem is rather what they're doing to society is in terms of things such as intellectual property protection, right? So I think those are many things. I think before they're starting to give back, I think it's important to start addressing those issues where really people are eventually damaged, right? So content creators of pictures in terms of visual art. So I think those are some of the major issues, and once you figure those out, then you can start talking about educating people or reducing your CO2 footprint and all of those other problems that are relevant. But I think it's just a matter of prioritization, because you can't handle all of them in an emerging technology.
Brilliant. Thank you. Alistair Milne comments, enjoying the presentation. He goes on, somewhat skeptical about increasing asset interconnectedness as we introduce new digital assets, stablecoins, CBDC, tokenized deposits, each with their own protocols. Are we not actually getting increased asset fragmentation? And if not, what is preventing this?
Yeah, excellent question. And indeed, I think that this is where the systemic risks grow very, very big, right? Especially if they are. Also an anecdote from the book, when I interviewed a metaverse fanatic, right? So he was a very big investor in metaverse, and he was telling me, great thing is I can mortgage my physical house, put it in an NFT, and then drop it in a DeFi protocol and use it as a mortgage, as collateral to buy a house in the metaverse and stuff like that. So it is possible, and it's fascinating to have those technical possibilities. But at the end of the day, this is very, very dangerous. And of course, the example that I described is dangerous on a personal level. But if you do that on a big scale, it can be dangerous on a systemic level. Just to give you an example of a bank that's doing that, Société Générale, a big French lender, they're actually raising capital by putting real estate bonds on a blockchain in a decentralized protocol. All right, so they're putting the mortgage onto the blockchain as a token, selling it, taking money, and when it matures, they just rewind the process. And if you imagine banks doing this large scale, this is okay. But what happens if this protocol gets hacked, right? So what happens if you have $100 billion in some digital assets that all of a sudden is moved to another wallet? And we know that the more complex those operations get, the higher the vulnerability. Just to give you a figure, we know that from studies that about 3 to 4% of all smart contracts out there have serious and significant vulnerabilities. So that's a 3 to 4% chance of getting hacked very badly, and that's, I think, something that we cannot accept on a larger scale. So I agree, it is definitely a problem. So we need oversight, we need regulation, and this is why I believe CBDCs can be a good alternative, because they could be an antidote to fragmentation. Why? Because the central bank can simply force the digital currency, like a digital pound, it can force it onto commercial banks or onto the end users at the end of the day.
Thank you very much. Tony Craddock offers big tech firms have tended to prefer to operate in a way that does not require licensing, as banks do, or in e-money institutions. Is this still the case? Will we see big techs becoming banks or EMIs, or will they just acquire payment firms that are already licensed, or some other option?
Yep. Excellent question, because it mentions basically all of the scenarios that we're looking at. So we have banks, we have big techs in China, but it can be happening in the West as well, that have acquired or built their own banks, licensed subsidiaries. And I'm now thinking of Alibaba. They have My Bank, which became one of the larger banks in China, basically, when the government in 2015 allowed private companies to apply for banking license too. And it's handling all of its financial assets. Now, in the West, we see more a mode of cooperation. You see it with Apple, Amazon, so they're cooperating with all of the big guys. I believe from their point of view, they don't want to be licensed, right? So they have a complete aversion to licensing. They don't even want to have a subsidiary in their corporate empires to do that. They prefer the partnership model. But I think that the higher the risks grow, the higher the pressure for them to be regulated. And this is not just me saying it. That's the Financial Stability Board. That's the International Monetary Fund. So you have all of these international institutions calling for them, right? Because we have a very, very high risk that we don't see, right? As I said, corporate core banking infrastructure in the cloud is running on big tech. If they issue any kind of stable coin, right, it would dominate basically multiple layers. And then they basically are completely global in their operations and also cross industry. There's mega industries that they're dominating. So I think that something will have to happen at one point in time, but of course they are pushing it as far away as possible.
And I think we have time for one more question from Kay Parl. Do you think that any of the regulators have the knowledge and expertise to keep up with and regulate the big tech and fintech sector?
I think they do. They're very smart people. I also got to know many of them for the book. And they understand it very, very well. The problem is just that the process takes longer, but it's not their fault. It's actually that's the nature of the whole thing, right? So regulators try to be very quick on the market, try to beat the competition, versus when you regulate something, you see what impact it's having. Just to give you now the most recent news on Bitcoin, you've seen how it soared over the last 2-3 days. Why was that? Because there was an assassination attempt on President Trump, and then they said, okay, if that increases the likelihood of him getting elected, he's pro-Bitcoin, so the price shot up, right? So this is just a very, very, it shows you the complexity of even the smallest hints. And let's say if the Bank of England says, okay, we're going to allow this or that, the prices would be crazy. So they have to be very, very diligent in what they're saying. Everything they write must consider all of the consequences, and this is why I think I think they're very qualified, but it's just a process that takes time.
Thank you so much. Well, we could run and run on this. It's clearly a subject provoking tremendous discussion. And thank you very much to all. I would love to thank our sponsors again, because again, without our sponsors, we cannot produce these seminars and webinars. I would very much like to thank you all for attending. You can see on the screen there are a number of FS Club forthcoming events coming up tomorrow and on next Monday. So there's a whole raft of stuff continuing to roll through the program. And last, and by no means least, I would very much like to thank Igor for tremendously thought-provoking contribution and for handling the questions so ably. And thank you to all, and I wish you all a good day or good evening wherever you are in the world. Goodbye for now.
Thank you, everybody.